Welcome to Real Estate IQ Wisdom for Smart Moves. We will explore the insider secrets tailored exclusively for Silicon Valley home buyers, sellers, and investors, arming you to conquer the unique real estate landscape. So, without further ado, let's dive into this exciting conversation.
In today's episode, we welcome Geraldine Serrano, a specialty tax consultant from Veritax Advisors. As a specialty tax consultant, she empowers residential and commercial real estate investors through cost segregation, optimizing their tax benefits and cash flow. Approximately 65% of commercial property investors remain unaware or don't utilize cost segregation. Each of these uninformed investors stands to benefit from an average of $750,000 in unrealized tax savings. Cumulatively, overlooking cost segregation leads to a staggering annual loss of $24.375 billion in unrealized tax savings across the U.S. market.
Disclosure. The following content is only for informational purposes. Please consult a licensed consultant for your specific situation or if you need any specific legal or tax advice.
Geraldine, welcome to the show.
Thank you for having me.
Give us a brief background about yourself.
I'm a Bay Area native, and for the past decade, I've been helping both residential and commercial real estate investors lower their taxes and improve their cash flow with a tax strategy called cost segregation. Most investors that I meet don't know about this tax strategy. So it's my mission to educate as many real estate investors that are out there to let them know that this tax strategy is available to them. Now, I have worked with investors all over the country. Even though I'm in the Bay Area, I have worked with investors in almost every state. And even though I'm in the Bay Area, I can do a cost segregation study on any property in any of the 50 states. So I've helped residential investors that have an ADU. They have a single family home that is a rental, a condo, a townhome, or any size apartment building. And I also have residential investors that do short or long-term rentals with only a portion of their home. So I help with those type of real estate investors. Also, I work with other types of investors on the commercial side. I work with real estate developers. I work with clients that have triple net lease properties. I work with tenants who don't own the building, but they own the improvements.
Sure.
And a perfect example of that would be a restaurant owner. They don't own the building, but they own the improvements inside the building where they have their restaurant.
Right.
So I work with a wide range of different investors all over the country.
So what is cost segregation and how is it different from the traditional depreciation methods?
When you buy property, you're typically buying two things. You're buying the building and you're buying the land. Now with the building, you get a non-cash tax deduction called depreciation. We take land out of the equation because you don't get any depreciation from the land. You only get it from the building.
So land never depreciates.
Right. Land's not depreciable. So all we're looking at is the building as far as depreciation is concerned.
Sure.
So that building is going to be depreciated over a certain amount of time. And residential and commercial buildings are on two different depreciation schedules. So residential buildings are depreciated over 27 and a half years.
I see.
And commercial buildings are depreciated over 39 years. And what that means is every year for that amount of time, you get a certain amount of depreciation that you can use to lower your tax liability. Now, with a cost segregation study, it identifies the different parts of the building that can give you more depreciation
I see.
than the annual depreciation that you get each year. So it is a detailed engineering analysis of the building. So it literally breaks out the building into every single component that was used to construct it. And it'll identify the parts of the building that can be depreciated over 5 years. So inside the building, we're going to find assets like carpet, decorative lighting, cabinets, wall coverings, certain portions of the electrical and the plumbing that can be depreciated over 5 years versus 27 and a half or 39 years.
Sure.
And outside the building, we're going to find assets that can be depreciated over 15 years. And those are going to be assets like land, those are going to be your land improvements like asphalt and landscaping. So the report is basically showing you how you can front load a significant amount of the depreciation that you can use today versus having to wait such a long time to get all that depreciation.
So what is the biggest tax saving success story which you have made possible?
So I was referred to a real estate investor from a client of mine. This real estate investor owns over 24 properties. And when I first met him, we talked about a recent acquisition that he had. So my company did a cost segregation study on it. Now, a year later, the same client comes to me and says, Geraldine, can we do a cost segregation study on a property that I refinanced? And I said, absolutely. The refinance has nothing to do with whether or not you can do a cost segregation study. Now, this client of mine has a huge tax bill. And he said, Geraldine, would you take a look at my portfolio and see how much we can lower my tax liability? I said, sure. Long story short, for a $200,000 fee, we were able to save him over $6 million in taxes.
Wow, that's huge.
So it's great working with these type of investors because especially when they hear about this tax strategy called cost segregation from another investor who was able to implement this strategy and save a lot of money in taxes, you know, in the end, they're very happy that someone they know told them about it.
Right.
And so he was very happy that he was able to save so much in taxes. And he was also very grateful that his friend told him about it because otherwise he would have had to pay that amount to the IRS.
What properties benefit most from cost segregation?
So cost segregation can be done on any residential or commercial property. The only property it cannot be done on is a primary residence. Now, on the residential side, I'll tell you a story about a client that was referred to me by her financial advisor. She had purchased a home in Calistoga for over $900,000. And at the time we did the estimate, we thought we could save her $100,000 in taxes. And my estimates are conservative. I don't want to overpromise and underdeliver. And without knowing what's at the property, what we'll find, I have no idea, you know, what results we'll get from the report and how much we could save her in taxes.
Sure.
So what ended up happening is I personally went to the property. There were so many upgrades, nice finishes that gave her high results in tax savings. And so instead of saving her $100,000 in taxes, she saved over $300,000 in taxes. And it was all because of what was inside and outside of that single family home. So it's all a matter of what's there and what assets can be on a faster depreciation schedule, right? And that goes the same on the commercial side. And what I mean by that is if we're looking at a warehouse that's not built out inside, and there's not much outside, there's not even a parking lot, then we're not going to find much
Right.
in assets that can be on a faster depreciation schedule. But if you have a restaurant that's built out, the kitchen, the dining room, the bar, we're going to find plenty that can be put on a faster depreciation schedule. And that also goes to say with a medical facility. That entire building on the inside is going to be built out. So we're going to definitely find a lot that can be put on a faster depreciation schedule as compared to a warehouse that's not built out and just used for storage.
Sure. How about a business who doesn't have any real estate associated with it?
So going back to the restaurants, they may not own the building,
Okay,
but they'll own the improvements.
I see.
So they, even though they own the real estate, they can benefit from doing a cost segregation study. And the same goes with a triple net lease owner, right? They have a tenant that owns the improvements,
Right.
but they don't, but they own the building. So both parties can benefit from the cost segregation study.
That's interesting. So dentists, lawyers, doctors, anybody who owns a business, they can benefit from the cost segregation strategy.
If they own the building or they own the improvements inside the space where they run their business.
So how does a typical cost segregation study works?
So initially I have a conversation with the real estate investor and we talk about their acquisition, their recent acquisition, or we talk about the properties they've have owned for more than a year. And from there, if it looks like they should look into a cost segregation study, I get some information from them. So if it's a recent acquisition, the property's not on a tax return, then I'll typically ask for a closing statement and an appraisal if they have one. That's all I need to do the estimate. If they've owned the property for more than a year and it's on their last tax return, then I'll ask for the federal depreciation schedule and an appraisal if they have one. And those pieces of information should give me enough, should be enough for me to do an estimate. And I do the estimate at no cost. Then after I have the estimate ready, I don't like to just blindly email it because especially for someone that has never done cost segregation before, they're not going to know how to read that estimate. So we'll review it together and it's going to tell them two things. It's going to tell them how much is it going to cost to do the study, and it's going to tell them how much do we think they're going to save in taxes. And from there, if they want to move forward, then that's when they sign a contract and provide 50% of the fee to get the work started. After I receive the signed contract and the deposit, then we schedule a physical inspection of the property. After the physical inspection is done, the report is typically done after 30 days of that completion of the inspection.
I see.
And there's a reason why we do the inspection. All of our reports come with an audit defense at no additional cost, which means that if the client is ever audited, we will be the ones to help their tax preparer answer any question from the IRS agent. So we do the inspection because we're going to take pictures, notes, and measurements, which are going to become part of the report.
Right.
So that we can answer any question that the IRS agent may have.
Right.
Also, we want to physically go to the property because we want to be able to identify every single asset that can be placed on a faster depreciation schedule. But that's the process. And during tax time, if a client needs a cost segregation study sooner than 30 days, then my company is able to do the cost segregation study a lot faster than 30 days. So for example, with this past March deadline, I had a real estate investor come to me a week before he needed that report.
I see.
That's obviously not an ideal situation because it puts a lot of stress and pressure on my team,
Right.
but we are designed to take those last minute requests. So we got the signed contract on a Friday. The next week, we were able to do the inspection. This was on a commercial building. It was over 100,000 square feet, over 30 tenants. The inspection took 2 days.
Wow.
So it was done the next Tuesday and Wednesday. We got the report to the client by Friday.
I see.
Because that's when they needed it to make sure they gave it to their CPA in order to finalize the tax return and submit it.
So what common myths exist about cost segregation?
One myth is that cost segregation can only be done on commercial buildings, and that's not true. It can be done on both a residential and commercial building. Also, a misconception about cost segregation is that people think that it can only be done on properties that were purchased over at least $1 million, and that's not true.
I see.
I have plenty of clients that live here in the Bay Area and they buy out of state, and they buy single family homes in Kentucky, Alabama, for either 100,000, 200,000, 300,000, and they can do a cost segregation study on those types of properties. So real estate investors should know that it can be done on both a residential and commercial building, and it doesn't have to be a property where the purchase price was over $1 million. Also, there's a lot of misconceptions on what type of property it can be done on. So, and what I mean by that is a lot of investors don't know they could do it on an ADU.
Oh,
So once they find that out, right, because especially here in the Bay Area, a lot of property owners are building ADUs on their property and renting them out.
that's true.
Also, they don't know that they can do it on, if they're doing a short or a long-term rental with part of their home, right? A lot of people do Airbnb, or they only rent out a certain portion of their home. They don't know that they can do cost segregation on that portion. So that's another myth or misconception about what you can do cost segregation on. Another misconception is, I had a developer build a commercial building in Oakland. He created this commercial building out of shipping containers. And so people wonder when they should have a conversation with someone about cost segregation. And the sooner you have a conversation about cost segregation before you buy the property, before you start a project, the better equipped you are on figuring out when you should do the cost segregation study and if you should even do it at all. And what I mean by that is, so going back to this example with this real estate developer, the $1 million question for him is, how did he attach those shipping containers together? Did he weld them, or did he use nuts and bolts? And the answer to that question was he welded them together.
Okay.
Well, if we had this conversation before he even began this project, he may or may not have changed his decision on welding those shipping containers together, because he chose to weld them together because of cost. It was cheaper to weld them together and not use nuts and bolts. However, if he used nuts and bolts, he would have gotten significantly more tax savings from doing a cost segregation study. But a lot of times when I meet these real estate investors, it's after they've completed constructing the building or they've renovated the property. And what I mean by that last piece is I have a lot of investors, let's say in Silicon Valley. They'll purchase an apartment building with the intention of doing a lot of renovations so that they can increase the rents. Well, if I speak to them after they've done the renovation, there's a missed opportunity on them maximizing the tax benefits they would have received from doing a cost segregation study. What I mean by that is, if we had a conversation before they did that renovation, I would have recommended a 2-part study, depending on how much renovation they were doing.
Sure.
But typically, I would recommend a 2-part study. The first part of the cost segregation study would capture the accelerated depreciation on the building as is.
Okay.
And the second part of the study would capture the accelerated depreciation on the improvements. Now, the first part of that cost segregation study would help with something called partial asset dispositions. The IRS says you can write off the remaining basis of whatever you throw away, but you have to do it in the year that you dispose of those assets. And also, in order to determine the remaining basis of whatever you're going to throw away, you're going to have someone be able to do some calculation. And so if you don't do a cost segregation study, all you see on your tax return are two line items. You see the value for the building and the value for the land.
The land.
Right? You don't see the building broken out.
Right.
So if you throw away the carpet, how does your tax preparer come up with the value of the carpet, especially the remaining basis? What was the value of the carpet when you purchased the building, and what's the value of it when you threw it away? So that's why it becomes really important to have that conversation with the real estate investor before they do anything with a property.
A typical problem homeowners have when wanting to buy a new home is whether to sell first or buy first. Either way is risky. When ready to look for a new home, TradeMyHome.com, powered by Your Home Sold Guaranteed Realty, offers an upfront guaranteed cash offer on your current home. Are you moving in the next 3 to 6 months? Text PAIR to 408-740-7400 for a free and no obligation professional equity appraisal report. For more information, visit TradeMyHome.com or call 408-740-7400. Remember, at TradeMyHome.com, your home is sold guaranteed or we'll buy it.
So how do investors stay compliant using cost segregation?
What investors should be aware of and make sure when they do a cost segregation study is that the report is done by someone that has a construction engineering background.
I see.
A lot of investors ask, well, why can't my CPA do it? Well, they're not construction engineers. Also, the report needs to be looked at by someone who can make sure the report is tax compliant. They need to know what assets can be on a faster depreciation schedule. So those are the two people that need to be able to do that report. Also, you need to make sure that there's proper documentation.
Sure.
You don't want to have a piece of paper that just has numbers on it. You want to have the backup that says, how did you come up with those numbers? Also, you want to make sure it's done by, as I mentioned earlier, a qualified professional. And you want to make sure that, tax laws change all the time.
Right.
So you always want to make sure that the report that's done is compliant. And one of the recent methods that people are doing now is the do-it-yourself cost segregation study. Well, I just talked about you have to make sure you have a construction engineering background and that the report's tax compliant, right? So I have investors that are being approached by companies saying, oh, you could do it yourself. Well, are you qualified to do a cost segregation study? But I think those are the things that you need to look out for.
And are there any hidden pitfalls which investors should be aware of?
The investors should be aware of that when you look into doing a cost segregation study, one of the important pieces of the puzzle is coming up with the building and land basis that you're going to use on your tax return. Now, I don't come up with those numbers. It is on the client and their tax preparer to come up with that number because they can be as aggressive or conservative as they want to be. And what I mean by that is if you buy property in San Francisco. It's not unusual that a lot of the value of the purchase price goes to the land, because in real estate, it's all about location. So 50%, let's say 50% would go to the building, 50% would go to the land. But investors know that the higher the number to the building is, the more depreciation you get.
Sure.
So they may want a higher number to go to the building because they know they'll get more depreciation that way. However, if they're audited, they're going to have to tell the IRS, why did they use a higher number to the building? And the IRS may not agree with them and may say that they have to change it. I've had investors be so aggressive in an area like that had a property in an area like San Francisco, and they chose 90% to go to the building. Now that is super aggressive.
That is super aggressive.
But for them, they don't mind taking the chance of being audited, because if they don't get audited, then of course they were able to get more depreciation per year because they put a higher number to the building. So that's something that investors should be aware of. An example I will give you is I was referred to a real estate investor here in the Silicon Valley. He purchased a single family home that's a rental, and he bought it for over $900,000. He didn't know that his CPA put the building at $200,000 on his tax return. So he wasn't getting as much depreciation as he could if that number was higher. He said he was so appreciative that he was referred to me by another investor, because when I pointed out to him how much was depreciation he was getting from the building because of the number his CPA put on his tax return, he was upset. So what happened is we had a conversation with his CPA, and he amended his tax return and showed the land at $200,000 and the rest to go to the building. But what happened is, I never recommend amending a tax return, because that's going to increase your chances of being audited. So what happened? He's in the middle of being audited, and the question from the IRS is, why did you change that number? And so the CPA chose that number because she was using the property tax records that showed the building at that amount. So that's why she chose the $200,000 number. She doesn't have to use it. In fact, the IRS's preferred method to come up with the building basis is to get a land-only appraisal. But most investors, they don't get a land-only appraisal. They get an appraisal on the building, typically for financing. And a lot of times it doesn't show a value to the land. So, and a lot of investors disagree with what is shown on the property tax records, right?
Right.
So my point is, there are different ways to come up with that number. So in this investor's case, he didn't have to use that number that the CPA chose. He just wished that they had a conversation about it, right? So that they could agree what was being put on his tax return. Some people say that the tax laws punish the ignorant, right? Most people don't look at their tax return. They give it to a tax preparer, they prepare a tax return, and the taxpayer just signs it. They're not going to know what to look for if they were to ever review their tax return. But this client was happy that I reviewed it with him as far as the real estate was concerned, because now he's educated and knows that, because he's continuing to buy more property, that he knows what to look for. So that's one important piece as far as when you look at your tax return in regards to your real estate investments, and making sure you're comfortable with what you're putting on for the building and land basis.
So how does cost segregation impact long-term financial planning?
So investors that do cost segregation, they do it because it's a time value of money play, right? So when they do cost segregation and they don't have to write a check to the IRS for $50,000 or $100,000, then they're able to do something else with the money. A lot of my clients, they'll use it to buy another property, or they'll use it to invest in something else, right? Or save for their children's college fund, right? So that's one. And then two, for families, it'll become part of their long-term financial planning because, so for example, a CPA reached out to me. Her clients are this couple. They're in their 90s and they have a real estate portfolio. So she thinks it's a good time to do cost segregation on their real estate investments because if they do the cost segregation studies now, they'll reap the benefits of lowering their tax liability, right? And then when they pass, the real estate there's going to be a step up in basis that's going to reset the depreciation clock for the heirs. So even though the parents did a cost segregation study on these real estate investments, now the heirs can do a cost segregation study because of how that depreciation clock reset.
Right.
So that's part of their planning so that both the parents and the children can benefit from doing a cost segregation study.
Where do you see cost segregation headed in the next decade?
I see it still being a tax strategy, but I also see that more investors are going to be aware of this tax strategy and more CPAs are going to be recommending it because if a real estate investor hears about cost segregation through someone else and not through their CPA, the first person they get upset with is their CPA. And then it's not unusual for my client to ask me to recommend another CPA. And so that CPA is going to lose business. So it's in their best interest to know about cost segregation and know how to implement the results into their client's tax return. So I see more investors and CPAs educated and using cost segregation. And unlike the 1031 exchange, where there's been a lot of talk about getting rid of it, there hasn't been any talk about getting rid of cost segregation. If anything, the tax laws were benefiting the taxpayers recently. So I just see there being more laws benefiting the real estate investors with the cost segregation study. And what I mean by that is in 2017, the tax laws changed regarding bonus depreciation. It stated that if you've purchased or newly constructed a property after September 27th, 2017, that property got 100% bonus depreciation. So what that means is instead of waiting 5 or 15 years to get that accelerated depreciation, you got all of it, 100% of it immediately that you could use to reduce your tax liability. Now that's if you've purchased a property after September 27th, 2017 and before the end of last year. Starting this year, that 100% decreased by 20%. So what that means is you don't get 100% of it, you get 80% of that total accelerated depreciation. It's going to continue to decrease 20% until it hits zero in 2027, right? So for now, right, with that tax laws change in 2017, then it's going to end in 2027, right? It's going to hit zero. However, it's still going, even if we didn't have that change in bonus depreciation, cost segregation was still around, and it still what benefited real estate investors. So even with cost segregation, even though there wouldn't be bonus depreciation unless the tax laws change again, in 2027, I see cost segregation still being available so that these real estate investors can still take advantage of it. I just see what I was saying earlier, that more investors and CPAs are going to be aware of cost segregation and will implement it if it makes sense for them, which is unlike today. A lot of investors, like this show, they're self-taught. They do their research and they hear, like, for example, I got a client that heard about cost segregation by being on Bigger Pockets, right? But the reason why he was referred to me is he asked his partner on one of his real estate investments to get a recommendation, and his CPA recommended me. So these investors, through the different networking circles they have, the different real estate investors they're around, or the research that they do online, that's how they've been learning about cost segregation. But the more and more investors that know about cost segregation, that word's going to get out. I was referred to an investor that is from Silicon Valley. He joined an all-male real estate investment group. This group is nationwide. And from him, after working with him and doing cost segregation on all his real estate investments, they have their pods, different pods of 4 male investors all over the country, and they also have their forums where they could post questions. Well, from there, my name got tossed around, so I've worked with these male real estate investors that are scattered all over the country. So I just feel that the more investors do cost segregation, know about it, and spread the word, and puts the CPA in this situation. And I don't want to say that not all CPAs don't recommend cost segregation or don't bring it up. Half of my business comes from tax CPAs. So there are the CPAs that know about cost segregation and would recommend it. We just need the other half to bring it up and make sure that their clients are aware of this tax strategy and can use it.
So what one advice will you give to the real estate investors who are looking at a huge tax bill?
I would tell them they should consider cost segregation if they don't want to write a check to the IRS. And I'll tell this story. A client of mine called me last year in March, and he was referred to me by someone he knows who happens to be a client of mine. He called me and said that he had his tax return in his hand, ready to sign and mail to the IRS with a check for $100,000. He told his friend about it. And his friend said, you should talk to Geraldine and see what she can do. And so he called me and he told me about his situation. I said, send me some information. He owns 12 rentals in Colorado, single family homes. And he does Airbnb with all of them. Well, actually, he does something called house hacking. So he Airbnbs all the rooms except for one that he lives in. And once the property starts cash flowing, then he moves out and he repeats the process. So at this time, he had 12 rentals. He sent me some information. All I needed was the closing statements and the appraisals. And I called him back after looking at the information with my team. And I said, yeah, if you don't want to write a check to the IRS for $100,000, you don't have to. And he said, great. He said, how are you going to do that? And I said, from all those 12 rentals, you got the depreciation. But all that depreciation you got still left you owing $100,000. So we need to do this cost segregation study on all the properties to squeeze out more depreciation to wipe out that $100,000 tax liability. And of course, this question is, Geraldine, you're in the Bay Area. I live in Colorado and my rentals are in Colorado. And I said, it's not a problem because I'm able to do a cost segregation study on any property in the United States. So, and also with the upcoming tax deadlines for September and October, it's right around the corner. Like I mentioned earlier, I'm able to do a cost segregation study for the September and October deadline. A lot of companies get to what's called at capacity, and they're not going to take on more work. But that's not the case with me. So if you know you're going to owe the IRS and you have this tax liability and you're going to file for the September or October deadline, then you should contact me, because if I can help you, there's still time.
That's awesome. Geraldine, it was such a pleasure talking to you today. Keep up the good work and let's stay in touch.
Thank you.
It's time for our trivia question to win prizes. This section is hosted by our AI host, Kay.
Hi, this is Kay from TradeMyHome.com, powered by Your Home Sold Guaranteed Realty. Your home sold guaranteed, or we'll buy it. Here is our real estate trivia question. Which U.S. state has the smallest recorded home? And your options are Texas, California, or Virginia. Winners will get a $25 Amazon gift card and recognition in our next episode. Submit your entry on your website trademyhome.com/REIQ or by scanning the QR code on your screen. Only the top 3 correct answers will win.
Thank you for listening to the podcast and acknowledging the wisdom of smart moves in real estate in Silicon Valley. Please share this episode with a friend, subscribe, and leave us a review on Apple Podcasts or wherever you listen to podcasts at Real Estate IQ. Thank you to our sponsor, TradeMyHome.com, for their client commitment and for making this podcast possible. If you're considering buying or selling a home, visit TradeMyHome.com. Until next time, remember to stay ahead in the real estate game.